Hey, happy Halloween. My pumpkin patch was a disaster this year. I had 51 vines going, barely got five or six of these. This is the actual one in the picture there. I'm going to talk about it. Lots of stuff going on this week, though. The government shutdown endures. Will it be ending soon? Who knows? Uh, the price of gold is still coming down. That indicates that investors are not leaving the stock market to invest in gold, which was a safe haven or a good long term investment. People are saying that gold is kind of topping out right now. So investors are moving into bonds the way they used to. Uh, Bonds more so than gold or cryptocurrency. And this is moving point three here. The 10-year bond is still under 4%. This is a great thing psychologically for the market as we get used to this. Hopefully, we continue to see the 10-year bond go down because mortgage rates follow just a couple of points above wherever the 10-year is at, 2.25% higher usually. A bad thing for the 30,000 Amazon employees being laid off is probably going to be a good thing for mortgage rates as the Fed has to deal with increasing unemployment numbers. Tomorrow is Wednesday, and the Federal Reserve will be meeting and announcing a likely 25 basis point or a quarter percent reduction in the Fed funds rate. That's the money at which they loan money to banks, the rate at which they loan money to banks. It could be baked into the 30-year fix. We think it's baked into the 30-year fixed rate. Hopefully, there's no boomerang where the Fed goes down and the 30-year fix goes up like the last few times. If there is, I think it'll be temporary. So I'm not going to lock anything quite tomorrow. No fixed rates tomorrow. Now, as the Fed does reduce the Fed funds rate, that does impact ARM loans, adjustable rate mortgages that have a fixed period for 5 or 7 or 10 years at the beginning of the loan. Those rates on those fixed periods, the beginnings, they do come down as the Fed reduces the Fed funds rate. They're kind of linked together. So, what you're showing in a second, what I mean here. The biggest thing the Fed can do tomorrow is talk about stopping the liquidation of their balance sheet, where they have a bunch of bonds and mortgage backed securities and they bought them all up during COVID to keep rates artificially low. They've been selling them off ever since then. That kind of floods the market and is one of the things preventing mortgage rates from improving at a faster clip. So if they announce that they're done doing that, the bond market's going to say, aha, bonds are a better investment now because the market's not being flooded. People could really move into bonds and we could see some real seismic shifts in where the 30-year fixed is by the end of the year. Fingers crossed about that. Let's look at some rates. These are not bought down. There's no discount fee connected to these interest rates. And this is the exact same slide I showed you last week. The 30-year fixed hovering around 6.125 with no discount. FHA, VA, USDA, all in the upper 5%. And that 10-year fixed ARM, fixed for the first 10 years, conventional loan, at about 5.75 with no discount fee. So we can see the improvement in these ARMs. ARM loans should be lower than 30-year fixed. They just haven't been because of something called bond yield inversion, which would put you to sleep if I kept talking about it. If we buy some rates down using discount fee here in this column, we can get that 30-year fixed in the upper fives. FHA, VA, and USDA are going to go into the lower fives, about 5.3 as of Monday afternoon, right? And a 7-year fixed ARM, fixed for the first 7 years, can be obtained in the upper fours, 4.875. For instance, that ARM costs 1.75% in discount at this moment right now. If the Fed reduces the Fed funds rate by 0.25%, that discount cost is going to go from 1.75% to 1.5%, more than likely in a couple days. That's what we like to see is those ARM loans really improve and kind of pierce through the forest for us a little bit, along with what will be FHA and VA. The jumbo loan amount over $806,500, still sitting around 5.25. That's in this example, it's a $2 million purchase price with 20% down, and looking good there. Two things that I'm doing as part of my business is I'm sending this out. Heidi sent it out to the Lake Oswego branch. I cut one for Salem as well. I'm going to get with Jerry about that. And it's just an email with a video in it that you, yes, you, could forward out to your clients after you sign them up just to say, hey, here's our lender. And I just talk about how I'm your in-house mortgage lender And I'm also available evenings and weekends and whenever it works. And it's just kind of an easygoing thing. I'm going to send it to be added to the meeting recap. And then I'm also doing, just to have it, a home buying seminar, kind of a first time home buyer seminar and a why buy now seminar. And it's not going to be an appointment. We're not going to buy a bunch of pizza and have people not show up because they had to pick the kids up. I'm just going to blast this out on social media and send it to you to forward to any new clients or people who are thinking about getting into home ownership. That way they can watch it on their phone in bed, or they can just, have it on, watch it a couple times. They could do some screen grabs from it and really kind of learn and get used to it without having to make an appointment, go across town. It can't pick the kids up from the school and stuff like that. So there's going to be something that's going to be kind of a living document that we can just send out to prospective purchasers that help them understand not just that they can buy a house, but they should do it now. That's what I have for you this week. I will see you tomorrow. We'll talk more about the Fed.